talk about the stock on our radar, Equitas Small Finance Bank. Their third quarter update has reflected a strong sequential growth in advances, while deposits too have grown strongly. However, in other news, the RBI has also given its approval for SBIMF to pick up 9.99% stake in the merged entity. To discuss this and more, we now have Mr. P.N. Vasudevan, who is the MD and CEO of the company. Thanks a lot, Mr. Vasudevan, for joining in once again. The last time we spoke, it was with regards to your decision of coming back to the company. You had said that, the second half of this year, growth will continue at 25%, and that seems to be the case in the first half of the second half of this year, which is the third quarter. What do you think the fourth quarter is likely to be? Do you believe that 25% is the run rate, or maybe you can scale it back to the 30% from which you scaled it down to 25% earlier?
Good morning. Happy New Year to all of you. Pre-corona, Equitas, we have generally been having a growth rate of around 30%. So we always expect that on a sustainable basis, we should be aiming around that 30% level. This is largely on two factors. One is that our size of the advances actually is very, very small. We are a very small bank compared to everybody else in the market. And so a percentage of 30% on that base is not something which is very dramatic. Second thing is the segment that we lend to, there's a lot of unmet demand because that's traditionally not been the banking sector's focus. And so there's a lot of, pent-up unmet demand in that segment. So a combination of this, we believe, is something where Equitas should be able to look at around the 30% level, give or take a few basis points here and there on a sustainable basis. So we had predicted a 30% growth for the current year also, coming off from the corona years. The first two quarters was a little low because some little bit of execution in the non-Tamil Nadu states was taking a little longer time. So we pared it down to 25, but in December we did achieve a 27% growth. And for the full year, we should be in the range of around 25 to 30. So give or take a few basis points, it should be around that.
Okay, all right, Mr. Vasudevan. So good to see the sectors that you're lending to, they're showing traction. And as well as on a low base, you expect to grow by 25 to 30%. Let's get a couple of aspects then out of the way. The credit deposit ratio, that's moved to around 106% odd. Don't you think it's time now to start focusing more on the liability size? Where do you see this basically stabilizing? The CD ratio, that's point number one. And also your CASA, that's come down to around 46% odd. It's come down on a sequential as well as on a year-on-year basis. Outlook on that, where is that number likely to stabilize?
Yeah, so the credit deposit ratio, we do get options from time to time of taking refinance from some of the financial institutions, and they come at a fairly attractive interest rate, given the fact that, we are either in affordable housing segment or we are in the very small business loan lending segment. So there's a lot of support that we get from the financial institutions by way of refinance at rates which are fairly attractive. And so we do a combination of deposit as well as refinance from some of those institutions. And that is why the CD ratio is around that 100% level. Going forward, we should expect that to be around that 95 to 100% level. Because we would continue to continue to aim at getting the benefit of lower refinance rates, given the kind of assets that we are actually building on the books.
By when does this come down, sir, to this 95 to 100% before you tackle the CASA part of it?
It also depends what will be the refinance norms of these lending institutions. So long as they continue to give us attractive rates for the kind of borrower that we are lending to, I don't see that actually coming down too fast because we would like to get the benefit of lower refinance rates. So I don't want to put a time frame, but definitely we will continue to mobilize deposits fairly well. And our deposit has been growing very strongly. So that's never an issue for us. We are only using the refinance from a cost perspective.
Right. You spoke about the cost perspective itself. I'm looking at your third quarter cost of funds. They've actually increased 16 basis points to 6.41%. What happens to your NIMs, your spreads going forward? Can you give us a sense? And while you're at it, also about credit cost. I mean, this 75 crore per quarter sort of run rate maintains, or do you see that improving or maybe exacerbating?
Okay. So on the NIMs part of it, cost of funds, yes, there was a 16 bips rise in the third quarter. Actually, we should look at some more increase in the cost of funds in the fourth quarter and probably the first quarter of next financial year, because the old deposits at lower rates are getting replaced by new deposits at a higher rate. So that takes some time to get played out, and that's starting to play out now. Parallelly, the bank has also been looking at our both operating leverages as well as some level of lending rate increase to the borrowers. So on a combination basis, we have been able to maintain the spreads, not necessarily the NIM. NIM is a reflection also of the change in mix of our lending from low ticket to medium ticket size loans. So that's a little bit of reduction in rates that we do when the ticket size goes up. So NIM is not necessarily the principal thing to look at from an Equitas perspective. It should be more our net spreads. And net spreads, we are confident that we should be able to maintain by a combination of better operating leverage, as well as partly passing on the interest cost to the borrowers. So that's on the spread part of it. As far as the credit cost part of it is concerned, pre-corona, our traditional annual credit cost used to be around the 1.1 to 1.2% level. During Corona, of course, it had gone substantially higher. This year being the first year post-Corona, we had guided for a 1.5% credit cost, which we should aim, which we are quite in line with that, and we should ensure that this year we do land at around that 1.5% level. And going forward into the future next few years, we should really expect our credit cost to go back to our pre-Corona levels.
Yeah, what about Mr. Vasudevan? We have that merger that's in the works, and you have indicated everything is on track as well. Give us a timeline. By when should this get done?
So we had kind of expected that before the financial year, that's before March, we should be able to complete the merger, is what we had been guiding all along.
Yes.
And I think we are fairly on track, because we had the final NCLT hearing on 21st of December last year, and all the approvals are in place. So we are awaiting the final orders from NCLT. So it is possible that, keeping our fingers crossed, we might even get it sometime during this month.
Okay, all right. Mr. Vasudevan, also you told us that spreads are more important than NIMs from your perspective. Give us a number out there. What's the broad range we should work with?
See, ultimately, we have to look at our ROAs. And, finally, the ROA reflects everything, whether it's operating cost, credit cost, or interest cost. Everything gets reflected in ROA. And, our ROA, ideally, we would always love to aim at around the 2% level. And second quarter, we were at 1.6% ROA. First quarter was 1.4. Second quarter was 1.6. And third quarter, as our credit cost comes down, and fourth quarter, as our credit cost continues to come down, we should aim to get close to our target of 2% ROA.
All right. And finally, before we let you go, a lot of approvals coming, funds, ways to increase their holdings, or rather hold up to 9.99% stake in the merged entity. That, of course, it was a regulatory requirement as well. But now that the ceiling for all of them have increased, have you heard from them looking to increase their stake in the merged entity? There is continuity at the top as well with you coming back. Any fundraising plans on the cards?
So there is no primary fundraise plan for the bank, because we are fairly well capitalized, around 23-24% capital adequacy level. So the primary capital raise plan at the bank today. In terms of the some of the investors seeking RBI approval, yes, that's nice for us to know that some of our old investors who have been backing Equitas Group for quite some time now are continuing to exhibit strong confidence in terms of backing up the merged entity going forward. So we hope that we will continue to be able to deliver value to all our stakeholders, that we should be able to retain the trust that they have been exhibiting on the bank. Okay,
all right. Well, it's good speaking to you, Mr. Vasudevan. So you're looking at continuing to grow at around 25 to 30%. The CD ratio over a span of time will come down to around 95 to 100%, but that could not be in a jiffy. And also the ROA target is headed towards that 2% odd mark. It's been good speaking to you. Thanks so much for joining in.